Hi, Maturate and Rima. Guys, nice to have you here. Um, I want to emphasize on financial analysis. I think that's where people have really interest, like the ratio analysis and also later on horizontal, vertical, and then trend. So that's why I'll give my emphasis. I can kindly confirm if you can hear me clearly. Rema, do you think you can hear me? Please confirm that you can hear me. Amy, Rehema.
Katabaz, we can hear you.
Okay, nice. We can start. The rest will just join us for those who will want to join us. Now, maybe to emphasize a few things. For ratio analysis, the thing is, the ratios themselves are universal and therefore you should know them. Okay, I'll tell you, for example, I've displayed here one of these. Say the gross profit margin. Yeah, these are standards. So say that you know or you don't. These ones don't have shortcuts. So for it to compute it, surprisingly, the lecturer says that this is not where we give marks. The marks are not here. So the marks are in analysis itself. But of course, you can't analyze with wrong ratios. So I don't know what that meant, but just to be clear, the ratios, you must know the ratios, okay? So to get back to the ratios themselves, so we know ratios, usually this, they either express percentages or fractions, or ratios themselves, okay, from our math. Okay, the ratios, they're expressed as fractions. With fractions, this way you have maybe x over y. Okay, that's a fraction. It can also be expressed as percentages. Okay, this is where whatever you get, if it is x over y multiplied by 100%. Okay, then the other way is the ratio itself. Okay, how I mean by that is say x to y. Okay, that's how we express ratios. Okay, nice ratios. Now in ratio analysis, we analyze based on these few things here that you see. Okay, we analyze based on the profitability. So I think best. Is it the basis? Okay, not really basis, but as you analyze, you're trying to determine the profitability of the entity. You want to determine the liquidity of the entity. You want to determine activity stroke efficiency ratios, or the efficiency, not ratios, but the efficiency. You want to determine the gearing and investor. So how do we mean by that? For profitability, here you're saying, is the business making profits or losses? Or in short, do incomes cover expenses? Okay, So and this ratios, by the way, as we analyze, it's really based on a profit. Okay, we are looking at a profit organization, or what we call for a profit organization or company, that your aim is to make a profit. This is what we're going to be analyzing, mind here. So the way we comment about them is we are keeping in mind that these are for-profit organizations. Their aim is to make profits, maximize profits. As a matter of fact, the main objective of an entity is usually maximization of wealth. Okay, wealth maximization, but this wealth maximization doesn't come from anywhere else. It actually comes from profits in the long run. Yeah. So in the short run, it's usually not visible, but once you accumulate profits for consistent period of time, you end up maximizing your wealth, because you will use your profit to buy assets and pay off your liabilities. Okay, so in the long run, the profit will allow you to maximize wealth. So now to get back to this, I was saying that as we analyze, we want to make sure that we are commenting on the profitability of the entity, liquidity, activity. So I was going line by line. Now for profitability, we're asking ourselves, do incomes cover all expenses or even exceed them? Okay, and have excess. Okay, this is when you're looking at profit making. Okay, when you're making a loss, or if your income is actually very low compared to your expenses, then you're not doing well as far as profitability is concerned. Okay, so I hope that is clear. So you're saying making a profit. Yeah? I just wanted to use this, but you're saying making. You're either making a profit or maximizing profits, or you're making losses. But our aim is really profitability. So every time you're making a profit, it is a good thing. Huh? It's a good thing. Or we say, okay, it's a good thing, not a good. It's a good thing. We all want to make profits. Then for liquidity really, it talks about things to do with mainly cash. Okay, cash present. Okay, but how do you not have enough cash or you're liquid enough? It's on a condition that you meet your obligations. They fall due. Okay, this is when we say you're liquid. You're liquid not because you have cash in your safe, if it is at office. No, you're liquid when you meet your obligations as they fall due. By obligations, we mean if the expenses, if the liabilities. Okay, whenever you need to spend money, you have actually money. If the salary, okay, those are obligations I'm referring to. Let me, we're saying salaries, we're saying expenses, we're saying liabilities, okay, debts and stuff. So if you're meeting these on a timely basis, as long as whenever they fall due, you're having money to pay them off, then you're saying you're liquid enough. Okay. Then can move on. Then there's activity or efficiency ratios. This one's here when we say you're efficient or what, or you're doing well as far as activities are concerned. Here we're saying if the assets you're using them, how can I say it, efficiently. Okay, by being efficient, I mean if you're having, say, a motor vehicle, how many trips does it make? Okay, if you're using motor vehicles to deliver, for example, sales, how many trips does it make? Okay, if it's making a lot of many trips, you're saying it's efficient. Something with assets, if you're using machinery or machines to produce or make products, which we later sell off, okay, the more goods you produce as a machine, you're saying you're efficient. Okay, so activity or efficiency ratios look at that. You have heard of, so yeah, I'm saying how efficient Efficiency has to do with time. How efficient are you? Efficiency is management. Okay, using the assets to generate revenues, for example. Okay, so if it is doing well compared to maybe the previous period or compared to the industry, then we say we are doing well, we are efficient. Okay, management is performing well. That's what I can say briefly about efficiency. Then gearing. For gearing, we say that here it looks at mainly the liquidity of an entity. Actually, that term we would use, I think, is leverage. Okay, so for gearing, we're saying how much debt are you using compared to equity as a source of finance. Okay, so you're sourcing finance, no funds, you're sourcing funds. However, we're saying how much debt are you using compared to equity. Okay. Equity, we say equity is your money, okay? The money of the owners, that is equity. So if debt exceeds equity, then it's always a problem. Okay, so gearing, always looking at that, the ratio of debt to equity mainly. So we're only better business. It's only good if you have less debt. Okay, this is not necessarily true because we know that we always have to have debt and equity at optimum level. So usually, the standard is usually 2 to 1. Okay, you don't have $2 for debt when you have $1 for equity, or even a better ratio. For example, we have 1 to 1, or even 0.1 to 1. Okay, so the smaller the I hope you're getting. Okay, here we're saying 1 to 1. We're saying debt. Okay, let me emphasize that this ratio is i.e. debt to equity. Okay, we're saying where you have 2 to 1, the standard says you're doing well. Where you have 1 to 1, I think you're still doing very well, even better than 2 to 1, because the debt is less. But all these ratios change based on the industry. Okay, you can actually have 0.5 to 1 debt to equity ratio, and yet you're not doing well. So it varies. Then for investor ratios here, you're looking at how is the investor in your business doing or finding your entity? Is he happy or unhappy? The true example is, for example, earnings per share. Okay, if the earnings per share, that means the owner of a share in your entity, he's earning per one share that he holds. If it is huge or big, you're saying that is on investor side, is seeing the entity is doing very well, and therefore potential investors can actually invest in your entity because of your investor ratio being good. Okay, so the better the investor ratios here, we're saying you can easily attract investment and your shareholders actually happy. Okay. I think another one could be dividend per share. Okay, here looks at the amount of dividend you're paying to every single share that is held. Okay, so when you're doing financial analysis, we ideally comment on the financials, okay, the financial statements, the P&L, and the statement of financial position, based on in trying to emphasize whether they are making us have a profit or not. Are we liquid enough or we are not? Are we efficient or we are not? Gearing ratio, are we high leveraged or we're actually at optimum or even less leveraged. Investors, are investors happy or not? Can we attract better or more investors or not? That is how we're going to be commenting on our financial statements. All right. So we're now going to emphasize profitability ratios. What do you find there? Liquidity, what do you find there? What are these ratios? And then you go about them. Okay. So profitability ratios. I already talked briefly about it, so I won't define the whole thing again. I'll just go straight to some of the examples of ratios that they find there and maybe comment accordingly. Okay, so we have gross profit margin. This one is given. The shortcut to understand this is whenever you see margin here, whenever you see margin, just know somewhere have revenues or what you call sales. Okay, you'll find they'll give you maybe net profit margin. They'll give you maybe which other example? Operating profit margin. Yeah, you must have sales somewhere. That's a shortcut. Okay, on another day they will say markup. Yeah, gross profit markup or operating profit markup. So the ratio is as this. It says gross profit over sales or revenues times 100%. Now this is expressed as a percentage. Okay. So I hope this is clear. Of course, for formulas, I really can't do much. Like I already explained to you. It's either you know or you don't. So try to find a way of going about them. Maybe what I can comment about this is let's take an example of a statement of financial position. Just a moment, let me get you statements and then have a feel. So I'm opening a financial statement or sets of financial statements. We look at the profit statement and so that we apply, we don't go back and forth. Okay, now this one was shared in class or it was done in class, but the clearest I can get. I tried to get past papers, but unfortunately, the images I got were not nice, so I couldn't use them. I shall use this again. Okay. This doesn't help for practice, but I have to understand it. Let's use this. Now, profit, gross profit margin. Okay, you know the ratio. So if you know the ratio, then you're good to go. Okay. So we're saying gross profit margin is given by gross profit over revenues or sales. So ideally, if I may just put this here. Okay, we're saying gross profit. I hope I've shared the screen. Yeah. So we're saying gross profit margin. Like I already said, it's just gross profit over. Okay, so you have the gross profit, which is 4,000 or 4,000 million. We divide it by the revenue, which is 29,500. Then times 100%. Okay. All right. So the figure you get or the computation you will get, I don't know how much. Someone can share with us the figure in the chat so that I don't turn to the Excel. Now this is for 2020. Okay. Then for 2019, you do the same. You get the gross profit of 2019 divided by the sales. Okay, you're just applying the ratio. Really, there's no magic or something like that. Something that you know. Okay. Then that. Okay, so someone can share with us the figure, please. Now the figures you get is the gross profit margin. That's how we compute them. Okay, we're going to comment on them later I prefer maybe learn how to compute. I think I can do both. Yeah. So you know the ratio, the formula, you apply it. Okay, it's gross profit over margin. You attach gross profit over gross profit over revenue times 100%. So whatever figure you get, you can easily see, even without looking at the figure, by the way, if you're commenting vertically. Yeah, vertically, how we comment about vertical, how we do the vertical analysis is usually we hold the revenue fixed, okay, and then every item is compared to revenue. Now in this case, we're comparing gross profit to revenue. Later on, you'll see distribution costs. We get the cost figure, which is 1050, not negative, but 1050, and divide it by the 29,500. Okay, now that's how we do the vertical analysis. How would I comment about it? Now, for most questions, as you'll see, they always ask for the comparative, okay, or what we call the horizontal analysis. And the reason is because I wanted to explain really how a figure, at the end of the day, there's a change, why there's a change, okay, in these two figures, because that's how we comment on performances. Okay, 14 and 27. Okay, thanks. So you have 14% here, then you have 27%. Okay, this is for 2020. Okay, we can't do anything. And this is for 2021. They wanted to comment, how come that in 2019, the profit margin was 27% and the gross profit margin was 14% in 2020, the year we're in now. So we wanted to comment on that, analyze. Okay, so by looking at profit, you're looking at profitability, the gross profit, profitability. So when you're commenting, you comment based on the performance of the entity. It's only doing well or performing well if the profit position is improving. Okay, so if you look at these ratios, of course, if I just comment on this, we're saying that gross profit margin is decreasing. I think I can also say it's decreasing from 27% to 14%. Okay, so you can say even the years, you can set clearly and say the years from 2019 to 2020. Yeah, we can all see that this is obvious. You're stating the obvious. Okay, that's why when you're analyzing horizontally or in any way, in this case, I'm doing the horizontal analysis, what you call the comparative analysis. What happens is the first thing is you set the obvious, and the obvious is from these computations. And these computations, like I say, they don't really give you a lot of marks. So you must know them, because of course you won't say that it decreased from 27% to 14% if you didn't compute rightly. You understand? Okay, do we have to give a reason? Yes. Yes, I'm doing it. So just be patient. We are line by line. So you comment in analysis. You comment, state the obvious, and give reasons, and even give implications. Okay, you don't just state and you think you've analyzed. Okay, so now analysis at our level, I think it's really simplified or easy. Why? Because you can even see it obviously. How? Now we're saying gross profit margin is decreasing. So what you do is you count these figures here. You're saying the 10 and 4, clearly they're decreasing. You can see that. But although at some point, these figures may not really tell the ratios. Okay, for example, it may come from 10 and stay as 10, but it's actually decreasing in terms of ratios. Okay, so but that notwithstanding, you ask yourself, what can cause, or what could have caused my profit, gross profit, to decline or decrease? And those usually come from the items that form gross profit, and these include revenue and cost of sales. Okay, so you must know this, that gross profit is given by revenue minus cost of sales. Okay, so cost of sales reduces the gross profit and revenue increases gross profit. You must be able to see that. Okay, so what will therefore lead to a decrease? Okay, there can only be a decrease on two conditions. That one, if your revenue is decreasing, this, okay, let me just say decrease. Okay, if your revenue is decreasing, chances are high that your gross profit will decrease. That is really obvious. And that's why if you're coming here, you would say, you don't say that it is decreasing because of what? Of decrease in revenue, but you say it is decreasing. It is decreasing. Actually, there's a tense you're supposed to use that you don't really commit yourself, because for some reason you're not you can't give an absolute answer. Okay, so the language you use shouldn't be committed, even though you can say that clearly that my revenues have decreased and chances are high that that's why my gross profit has decreased. Okay, but it's not so absolute. So the things you use, you make sure that you don't commit yourself. So I will say it could be, okay, due to. Okay, so always use this. It could be due to, or it may be due to. Okay, by saying that you're not committing yourself, let me use may. May be due to. Is the font okay, guys? Are you seeing what I'm typing? I don't want to. See if I can increase. Okay, it could be, it may be due to decrease in revenues or sales from, you say, from the figures from 36,000 to 29. 29 by please guys, don't unmute. If you're asking your question, you type it. Okay, please type. Beatrice, please type, because the network is okay and you're going to discuss. So the network. Whoever has a question, kindly, or a suggestion or an opinion, kindly chat to avoid network issues. Okay, so I was saying that what you say here is you don't commit yourself in terms of tense. Okay, but what is obvious is the gross profit can only reduce. If I may just show you mathematically here, we're saying gross profit is equal to revenue or sales minus cost of sales. Okay. We're saying that this figure here, if it is say 2,000, can only be equal to 10,000 minus 8,000. Okay. If I want to reduce it, or if it's going to reduce, if, for example, revenues increase by 2,000, okay, like in this case, it decreased, okay, we're saying that what will my gross profit be? If my revenues increase by 2,000, okay, holding this other constant, we're saying my gross profit be equal to 4,000. It is increasing because revenue has increased. Okay. If I may reduce it, okay, now, if I may reduce it, Oh, sorry about that. So if I may reduce it, you'll see the reverse. Assuming I reduce my revenues by 1,000, okay, my gross profit will be, if I reduce revenues by 1,000, so we're saying revenue is now 9,000 minus the 8,000, my gross profit will be 1,000. Okay, so these are obvious things. I really don't want to really chew your time because I know you know these. Okay, so allow me continue. Okay, so when you're commenting, therefore, that's what you base on. If you see gross profit is reducing, it cannot reduce if revenues have reduced. Or there could be another option, which is the costs now increasing instead. Okay, but they are also not increasing; they're reducing. Okay, so when costs are reducing, you don't want to say that your gross profit is reducing. Okay, ideally, whenever cost of sales reduces, you expect your gross profit to increase. Okay, now for most of us here, want simple things, and therefore I would encourage you to only concentrate on what is causing the change and don't give an eye to the other. Okay, although personally and a few others, I'm sure they can still comment responsibly using both revenues and cost of sales. But for the purposes of passing, let me just concentrate on that. Let me just stick on the simple. So the simple one is the likely cause, because yeah, if someone comes, the lecturer comes to check this statement, there's no way he can disapprove this statement. There's no way he can refuse to mark it, because we all know that we are all seeing that the revenues are reducing. Okay, so for cost of sales, I would comment on it, but I prefer not to for the purposes of the rest of the class. Okay, so let's go to the next thing. Now that is gross profit margin. That's how you compute it, and that's how you comment on it if you're doing the horizontal analysis. Okay, I can respond to some chats. What's the difference between horizontal and vertical? Okay, sure. Vertical analysis, no, it's horizontal. How do we comment on horizontal? All right. Now, for horizontal analysis, we are comparing. It's really comparison. Okay, you compare this period and the previous period. If they don't give you the previous period, they will give you at least the industry ratios. Yeah. So you must compare with something. That is for horizontal. So guys, that is gross profit. Okay. I'm going to get another profitability ratio, we comment on it, and then we go to the next thing. Okay. So let's look at the other one was net. It was operating profit. Okay. Operating profit margin or net profit margin. Let's do net profit. Okay, this is the ratio here. So they're saying that operating profit margin, of course, we know this is still a ratio used to measure the performance of an entity, specifically profit. What do you mean by giving us? Okay, the industry figures is they will get you, they will tell you that the prevailing industry profit or gross profit margin is say 50%. They will tell you that. So what happens is with the industry information, analysts and other firms usually get information regarding particular industries, say education, say insurance, say bank. Yeah. Then they will issue what you call a prevailing performances, industry performance. So they will tell you that in insurance industry, for example, that the gross profit margin or the average gross profit margin is 20%. So when they tell you that and you compute your own, you compare with the two. You see whether are you doing well or doing poorly based on the industry performance. Okay, I hope I've answered whoever was asking about the industry. Okay, now I said for ratios, you must know the formulas. Okay, there's no shortcut. Now, for operating profit margin, they say it is profit from operating, what you call profit before interest and tax divided by the sales revenue. Okay, it's different from net profit margin. Net profit margin looks at net profit. Actually, it looks at profit after tax. Yeah, so they're two different. So whenever I say operating profit, they're saying profit before interest and tax over sales revenue times 100%. So we can go and apply that in our question and see. Okay, so here's the question. So we're looking at operating profit margin. Now the formula is clear. They're saying you get profit before interest and tax. Now when you come and look for profit before interest and tax, even if I begin from gross profit margin, going down, you have profit or loss before taxation. Okay, this is the standing outline. Okay, now profit before tax is not the same as profit before interest and tax, but what we know is you can use it to get profit before interest and tax. Okay, so what we do is we get this figure of profit before tax, and it's actually a loss. So for 2015 is a loss, so you put a loss of 2,500. Okay, and then you are removing the interest. Now the interest is the finance cost. This finance cost is the interest. Now how we remove it is for expenses, we add them back. For incomes, we subtract them. And the reason is because an expense will reduce the profit. So if therefore if you're removing it, you're supposed to add back so that the profit is restored to a higher figure where the expense was not deducted. Okay, so but because this is a loss, it can only increase. The loss can only increase. The loss can only reduce whenever you remove the expense. Okay, if it was a profit, it would have to increase whenever you remove the expense. I hope we are together. Okay, feel free to ask in case you don't understand. Okay, so now therefore my profit, I think I should have put it somewhere here. You say profit before interest and tax. I have a loss of 2,500. Okay, I'm removing an expense that I incurred. Okay, so this will give me, I think, a loss of 1,900. Some more light on the finance costs. Finance costs, like I said, they're the same as interest costs. The other name for this is interest costs. Okay, from our financial management and even from accounting 3. Okay, financial reporting. All right, so this is interest, the same as interest. I hope I've answered you, Beatrice. Okay, so we are removing it so that we are restored to profit before interest and tax. Okay, so you have this loss. Okay, now guys, I think I'll start from here. In a few minutes, the link is going to close, so kindly join in as soon as you log off so that we continue. Okay, so as maybe it goes off, I can still emphasize that the ratios, guys, it's either you know it or you don't. And the only way you can know it is if you have practiced it already a night before. Okay, something like that. Okay, so ratios are easy to compute, but the issue is interpretation. I haven't gotten it. It was tricky. Okay, so just in short, I'll just repeat it as soon as we join the new link. Okay, it's the same link, just rejoin after it has locked.